Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Monday, August 11th, and I am so excited for today's show. I got to say, it is feeling like the dog days of summer right now, but we have got a busy show planned for you today. We're going to get to the NVIDIA and AMD news from over the weekend. We are also talking to Bain Capital Ventures' newest partners. They are both coming on the show. We're also going to talk about one venture capitalist view that founders aren't dreaming anymore. I'm excited to get that take. But I want to start off with a big story that we published this morning at The Information. You might think that all venture capitalists are off vacationing in Europe right now, but the truth of the matter is that venture has never been busier because of the fact that AI has every investor on their toes. And I want to bring on our venture capital reporter, Natasha Mascarenhas, and also John Sakoda from Decibel to talk about this phenomenon. Natasha and John, welcome to TITV. It's great to have you here.
Great to be here.
Thanks for having me.
Natasha, tell us about the story you wrote this morning.
Yeah, listen, I've been reporting on venture capital for the better part of a decade, and it is definitely the busiest summer I've seen yet. So the story was pretty inspired by that. About a year ago, you would hear from venture capitalists, and they would tell you that it's a tale of two cities in fundraising right now. The best companies can raise and the others can't. Fast forward to this summer, there's a lot more companies that fit into that best category. And so we're seeing sort of unprecedented speed to write checks, unsolicited term sheets, and just a lot of pretty frenetic deal making in Silicon Valley. So that was my goal with this story, was really to put some words to paper there.
And so tell us about some of the examples you found. I mean, these are stories of venture capitalists giving term sheets unsolicited to founders. I mean, tell us about some of the examples that you got to.
Yeah, definitely. One example that I ran into pretty quickly was a company called Mercor. It helps companies like OpenAI and other AI startups work with contractors or find full-time employees. And I ran into an example where one of their lead investors, Felicis, preempted them with a $2 billion valued term sheet about, when the company was only 2 years old.
$2 billion that's a funding round.
Yes, a funding round. So the funding round valued the company at $2 billion, about 100 times its run rate, its revenue at the time. And, at the same time, when I chatted with the CEO, Brendan Foody, he was saying that he's actually had to tell his investors to not send unsolicited term sheets. So even at this one example, it's a tale of two stories. They don't want it, but it does work sometimes. In other examples, you're seeing investors sort of look to court founders for 6 months or, weeks before the company, they actually approach the company. And it all points towards a lot of investor excitement and trying to do work in stealth beside a company that's maybe ignoring your talks.
So, John, I mean, what happened to due diligence? What happened to that?
Well, what I would say is AI is perhaps the biggest super cycle. It's a tectonic shift that we've seen. I think it's a space that is hyper competitive. So I think you have people who are doing a lot of work up front. They're trying to research every single possible startup that's growing quickly. And then if they can find one that they think could be a category killer, they will try to preempt and get in because, as Natasha has reported, the valuations go up incredibly quickly, incredibly fast. So if you don't get in early, it is incredibly difficult to get in at a reasonable price.
John, I want to talk to you about your portfolio companies that must be going through this right now. We heard examples of, again, founders saying, just give us a second to breathe. I mean, we don't need the term sheet just yet. I mean, isn't it distracting for founders to try to build a company when you have to be so worried about, do I fundraise? Do I not fundraise? Do I, how do I manage this?
I'm really glad you're asking that question. Often when we launch a company, we might get somewhere between 50 to 100 inbound emails from investors. Now, that does not necessarily mean that you're going to get 50 to 100 term sheets, but certainly the demand is there. So if you do have a really promising company that could be a leader in this new tectonic shift, investors want to see if they can get in as quickly as possible. So it does very much feel like a frenzy.
John, I want to get to the data that you guys collected in a second, but very quickly, Natasha, this idea of a preemptive deal or being preempted or getting an unsolicited offer. I mean, does that definition change depending on who you talk to?
Definitely changes depending on who you talk to. I mean, there's many shades of it. In some cases, it's truly a classic preemption where an investor has done work on you, shows up, and offers you a term sheet at a valuation they think is fair. In other cases, it's a little sneakier than that. I spoke to some investors who said that the word has lost all of its meaning, the word being preemption. And a lot of founders will say that they're getting preempted, but in fact, they have been sliding over their financial information, doing coffee meetings, and sort of doing a fundraising without actually doing a fundraising. And so exactly like John said, 25 emails, 25 even verbal offers does not necessarily lead to 25 term sheets. So definitely digging into what the word means.
So it's kind of just like, you can walk on the street and say, yeah, it was unsolicited, when really it was like, well, we actually had 3 coffees, before we got the term sheet.
If you're giving your financial information away and you're taking investor meetings, you're fundraising, even if you're not saying you are.
Yeah. John, your firm collects this interesting data set around dry powder. Tell us about what you found there.
Yeah, for the past decade or so, in collaboration with the information, we have been tracking how much venture capital is available for startups. So as you might imagine, it's a relatively simple formula. It's the amount of capital that is raised, and that represents the dry powder. It's the amount of money that can be raised. And then obviously we deduct the investments. So dollars in minus dollars out is effectively the dry powder. In COVID, we saw a tremendous run up in dry powder. We saw record levels of fundraising, and it really peaked in 2023 on the back of what were incredibly strong fundraising years in 21 and 22. So we were at around 300 billion. Natasha and I had been studying this for many quarters now. The number hadn't really come down dramatically, and we were wondering why that was the case. And anecdotally, it just didn't feel like it didn't feel like the industry was that slow. So it just felt like at some point the money's got to flow. And the reality is that really in the last 6 months and really leading up to this moment, we've seen a real unleashing now of the capital. It is at a run rate that is record setting. I mean, the levels that we're at now are surpassing 2020 levels. On the flip side, we don't have strong fundraising. So this is one of the reasons why you see such a decline in dry powder is you have incredibly strong levels of investment, but you have some of the weakest fundraising numbers that we've seen in a while. So
why is that?
Well, this has been relatively well known in the industry. We're now sitting on over $1 trillion of illiquidity, so private assets. And the LPs have wanted to see more distribution. So we have not as much liquidity as we would like to have. Now, there's been very positive signs of this changing. So the Figma IPO is one example, the Wiz acquisition by Google. These are examples of money coming back into the system, which of course people would want to invest in AI. But until that part changes, the LPs have not had enough of their own dry powder to commit to venture capital. So on the one hand, we have the beginning of this incredible super cycle.
Yeah.
But on the other hand, we're on the tail end of what has been a period of illiquidity, and it just needs to catch up.
But Natasha, I mean, we've talked on the show about, the IPO window. It's not as open as some people would hope. And yet you have these giant private funding rounds, which are offering some kind of liquidity, or at least the secondary market is getting hotter, warmer, so is that not helping at all with this?
It definitely is. And I think it's actually, a third factor I came across when doing this reporting was really seeing companies like Google and Meta and Microsoft be willing to pay pretty high price tags for companies in the space. And so before, if you backed a small technical team that had maybe a few $1 million in revenue, it would either be zero or a formal exit. Now there's some downside risk protection. And so that's why I think you're also seeing, and I include this in my piece, investors just go earlier, not just more often, but earlier as well. So they don't have to wait for that huge exit. I mean, I know that Figma investors are super excited in this moment, but for everyone else, they're looking to a lot of different factors to get their money out of the market, even if it means, not your classic headline grabbing acquisition or IPO.
John, I want to come back to the pace of deal activity right now with respect to AI. Have venture firms changed their structure at all, or have they changed the way they play the game to adapt to this pace and move quicker?
Well, I do think you're seeing the venture funds themselves supersize their funds in order to try to keep up with the capital intensive nature of AI. So in some ways, like we are in the beginning of a new tectonic shift, and it is one that requires quite a bit of capital. So I think there's been numbers
So they're
reported.
raising more, right?
Yeah, on average, AI tends to be a more unprofitable and more capital-intensive paradigm than other ones. So we see companies now burning maybe $5
Right.
For every dollar of revenue that they're reporting. These are numbers that were recently reported by Silicon Valley Bank. And anecdotally, a lot of companies are either at low gross margin or negative gross margin. So you see in some ways like a need to overcapitalize your company for the hope that you can get enough market share, enough volume in order to drive your margins back up.
Right. I mean, more what I was trying to get at was, at Decibel, for example, given that you have to move quicker to be competitive in this market, I mean, have you guys changed the structure of your firm at all insofar as, maybe the associate is talking to the partner quicker, or, given that there's less time to do due diligence, have you changed the way that you research companies? How have you adapted?
Thank you for asking. At Decibel specifically, in order to respond to these kinds of deal cycles, from the very beginning when we were founded, we did not actually have a hierarchical or layered system. Partially for this reason, I think in order for a firm to be able to compete at the speed of the market, it needs to be able to make decisions incredibly quickly. So in some ways, like the flatter the organization, the more in sync an organization is, the easier it is to be able to meet founders where they are. I also think in some ways, specialization is a big part of that. If you are explaining to your partners everything that's going on in the market, it is incredibly difficult to keep up with the pace of the market. And so in some ways, by becoming a specialist, you can operate at a much faster speed because there's just a lot less explaining to do.
Natasha, last question for you. What questions are you trying to answer now coming out of the story?
Yeah, I mean, listen, I think what John said about venture capitalists sitting on less and less dry powder if this investment cadence continues for the foreseeable future is a huge storyline to prove out, right? I mean, are we going to see investment firms shut down because they've overspent and they didn't have enough runway? I mean, investors all the time talk to startups about maintaining their runway and being smart about the way that they spend their money. But we're going to need to see venture capitalists do that as well. And that's what I'm watching.
Great. Well, thank you, Natasha and John, both for coming on. John, thank you for sharing that data with us. It was great to have you both here. That is Natasha from The Information and John from Decibel. Okay, for our next story, before we get to our next guest, I want to talk about a big story out of NVIDIA and AMD from over the weekend. Now, you might remember last week, both companies got the green lights from the U.S. government to sell a version of their chips in China. But yesterday, the Financial Times reported that both companies will give the U.S. government a 15% cut of their chip sales in China, which is quite the arrangement. We were talking about this earlier this morning in the newsroom, and I think the most interesting part of this story is just how far NVIDIA is willing to go to make sure that developers in China don't actually move off its hardware. I mean, at this point, it's less about how much money they can make in China from those chip sales, and it's more about stopping developers from moving to use competing firms' chips. And so really, it is an unprecedented arrangement, and we look forward to seeing how that evolves. Now, for our next segment, Bain Capital Ventures has also had a busy summer. Over the past few months, they have led investments into healthcare companies, construction companies, legal tech companies, and the company also just named 2 new partners, Abby Meyers and Ron Miasnik. They are both 2 rising stars in the land of venture capital, and I want to bring them on both to talk to us about what they've got planned for their new gigs. Abby and Ron, welcome to the show.
Thanks for having us, Akash.
Thank you so much, Akash. Great to be here.
So you are the newest partners. How'd you guys celebrate?
Well, I think Ron was headed to IC today, so I may have had the more fun celebration, but got together with some friends on Cape Cod this weekend.
Okay. Ron, how was the IC?
In a few hours, so I'll let you know.
There you go. Yeah. All right. Well, look, let's talk about what you both are focused on. Abby, you have this interesting area. You are looking at AI, but you've invested largely in companies outside of AI. Tell us about what you've been working on.
Yeah, I think AI is a really foundational and transformative technology, and I think it's touching everything we do. But I think I also spend a lot of time thinking through the questions of kind of what secular trends or market disruptions are happening that necessitate new technology. I think if we look at precedent kind of breakout tech companies, there's often some kind of technological advancement, but sometimes there isn't. And there is almost always some kind of market disruption, change in how we do things that requires a new technology. So I focus on Series B and beyond application software and AI investments, and I kind of try to take the lens of how our market's changing, how are secular trends impacting how we live and work, and what type of technology do we need to keep up.
Right. And so what sectors specifically have you been focused on?
Recently, I've been spending a good amount of time on technology for physical work and kind of the real world. So MaintainX is one company we recently doubled down on that I'm really excited about.
And what do they do?
They're a computerized maintenance management system. So they put software into the hands of frontline workers that help them track work, manage assets, and it feeds back a lot of data to their broader organizations. I think to the kind of point of secular trends, there's a tremendous labor shortage in the front line. Meanwhile, there's kind of supply chain pressures starting with COVID up until the reshoring, nearshoring that we're seeing right now. And I think there is kind of an unprecedented need for technology to optimize real world activities. So that area is something super exciting.
Ron, you've been looking at stuff outside of AI as well, right?
Yeah. So I'd say my two primary focus areas at Bain for the past couple of years have been one, I've been actually, working to build out a practice in Israel. So Bain Capital has had a long history of investing in Israeli startups, starting over a decade ago with companies like Redis and Armis, and we really, made a commitment to double down on that ecosystem again about a year or two ago, and we've been really active out there, right? So we've now deployed $150 million plus into the ecosystem over the last year, focused, I'd say, mostly but not exclusively on security companies. The ecosystem in Israel has long produced very, incredible companies, incredible entrepreneurs with a core of security, given the kind of the military background, but also over time, not only security companies, and we've invested in a handful of fintech companies, infrastructure software companies out there, and are excited to double down on that ecosystem. The other theme that sorry, go ahead.
I was going to ask you, as it relates to the startup ecosystem in Israel, what has changed over the past year that you've noticed?
I think really, I'll take it in a few different ways. One, over the past 5 to 10 years, we've seen Israeli founders dream bigger, right? I think if you look at the history of the Israeli ecosystem, it started off with a series of very technical teams solving very particular problems, and then mostly getting acquired by larger American companies. Then really over the past 5-10 years, Israeli entrepreneurs have become more commercial, more ambitious with the goal of building independent, unicorn scale public companies in Israel, right? And so we've started to see that secular trend over the past 5-10 years. And I think it's become more clear than ever over the past year or two.
And why do you think, what do you attribute that to?
Yeah, it's a good question. It's really a maturing ecosystem, right? I think, at its core, Israel was, or one of the things that makes Israel strong is this military training that everyone goes through, right? Every single person in Israel, the next line item on the resume after high school is the army, right? And so Israelis from age 18 get trained in very complex, deep cybersecurity and infrastructure software problems in a very entrepreneurial, high-risk environment, right? And so a lot of these folks then go spin out from the army and go start startups. And so that's been the history of the ecosystem for a while. But as those startups started going better and better, and there started to become more capital in the ecosystem, Israeli entrepreneurs started to become more sophisticated in company building methodologies. Then a lot of times the second run and third run of these founders, they're ready to swing bigger, right? And so now I'd say actually the default pitch we see in Israel is we want to go aim for a big public company. And
so there's a lot of second and third time founders that are coming back.
Exactly. And now there's second, third time founders. There's layers of angel investors and venture capital funds in the ecosystem that have been through the rounds a couple of times. There's layers of engineering management and financial management and product management in a way that is not dissimilar from Silicon Valley, right?
Right.
An ecosystem that's progressed over the past couple of decades, and we're just seeing the quality be world class. And so we're really excited to double down.
Abby, I want to come back to you, and I want to come back to this idea of what's interesting outside of AI right now. You had this investment in this company called WAP, And I want you to tell us about what the company does. And I also want to ask you about your due diligence process, because I read online one of the things you did for your due diligence was that you were talking to creators on Discord and Reddit as you were researching the company. I mean, we do that as reporters, but I didn't know people do that as venture capitalists. So tell us about, what that company is and how you found it.
WAP is kind of like Shopify for the creator economy. The trend that we noticed was there was a new generation of digital entrepreneurs that were building online goods. So things like communities where their followers could interact, online courses, games, all of that. And they needed infrastructure to manage subscriptions and monetize their following. And there was real demand to have infrastructure that let them monetize their following across all the ways they wanted to in one place. And so WAP kind of provides that digital commerce infrastructure to enable this new generation of creators. And so during the diligence process, I think that I realized that I just didn't fundamentally understand this kind of wave of creators, and I really wanted to. And so I thought the best way to get smart there was to put myself in the shoes of, say, a 20-year-old male day trading enthusiast and join those groups, kind of interact as one of the folks using the WAP platform. So spend a good amount of time in, call it, their top 15, 20, as well as some just random picks across the platform to understand just how deeply and eagerly people were engaging with this new type.
What was the most surprising thing that you learned?
I think just how active and just the communities were and just how engaged the community members were. I had no, understanding of how huge this shift was.
Ron, let's talk about your investments outside of AI, adjacent to AI, I should say. You've also been paying attention to these, traditional industries, stuff like insurance, homeowners association. Why have you been focused there?
Yeah, I think one of the things that we're realizing more and more is that a lot of the opportunity for applying AI and a lot of the enterprise value creation opportunity in AI comes from these more traditional service sectors, right? In places that traditionally Silicon Valley does not hang out in as much, right? And so we're actually seeing a lot of incredible founders and, surprisingly as well, technical talent be really, really interested in working on these really niche-y, historically unsexy industries, right? And moving over to work on, like you're saying, homeowners associations, PEOs, property managers, insurance administration, 401k administration, all these other parts of the world, primarily because, one, there's a huge market opportunity there, and there's an opportunity to put AI into these more traditional industries. But these are also really interesting technical and commercial problems, right? You're hanging out with these people and places and areas that you don't run into in Silicon Valley. Right. And so actually a lot of what we've seen our role as Bain Capital is to be that bridge. Right. One of the cool parts of being at Bain for the past couple of years is that Bain Capital actually, in many ways, primarily is a global asset manager. Right.
You're talking about Bain Capital, the Bain Capital, the asset management company, the private equity company, not Bain Capital Ventures here.
Yeah, but we're all one large organization, right? And so at the end of the day, when you sit at Bain Capital Ventures, you are able to touch the rest of the world in a really meaningful way. And so a lot of times, the insights that come from our private equity colleagues or our credit colleagues or our insurance colleagues that work at other funds at the firm inform then our investing that happens on the venture capital side.
So then how do you plug into that then as a venture team?
So we spend a huge amount of time with our private equity teams going and assessing the AI opportunity in more traditional industries, right? They will come to us and say, hey, we're looking at buying this big company. We're looking at assessing this new market. What do we do with AI here? Right. And then we can go help them and actually introduce them to engineers to go plug into these companies. We sometimes say, hey, well, we actually think there's a market opportunity to go build a business that, the businesses that we own can go buy. Right. Or sometimes we look at a market end to end with our private equity colleagues and say, hey, actually, we think we can disrupt this. Right. We think there's an opportunity to go build a net new player that's actually a more traditional service business in a more AI native way.
And so what is AI actually doing then for these businesses?
Yeah. So I guess there's a couple of things they might do. Right? One is there's a lot of internal operational efficiency, right? That AI can go really improve, right? And so, there's many internal processes and operations in these companies that are, historic, that are still live in, 20 or 30 years ago.
It's like finance and stuff like that.
Finance and operation. Many of these companies, many of these businesses, at the end of the day, are still running on fax. Right. And so you have, his text in, text out processes that are hyper legacy that that are a trivial task for an LLM. And so AI can completely transform these. But actually, in many ways, more interestingly to us, AI can actually completely change the customer experience. Right? There's many of these industries, whether again TPAs, PEOs, homeowner associate, we kind of consider these like the three-letter acronym industries.
Right.
These kind of more legacy service sectors where customers have gotten used to having 2-week turnaround times with 30% inaccuracy rates, and not getting a call back from their customer service rep. Right. And so we see a huge opportunity now with AI to go completely transform not only the internal operations of these businesses, but also the customer experience, and do it in a much more kind of vertically integrated manner. To actually not only build tools and point solutions for these businesses, but also take on these markets end to end. Right. Build the next generation law firm, build the next generation accounting firm, build the next, and in a way that was just not possible when you didn't have the type of automation. Yeah.
Great. Well, look, Abby and Ron, you have two very interesting focus areas. I had never heard of WAP, and I had also not really heard of AI, automating some of these traditional industries, although that is something that we've written about at the information, and I'll link a few of those stories in the show notes. But thank you, both of you, for being here. Congratulations on your new appointment as partners. That is Abby and Ron, the newest partner at Bain Capital Ventures. Okay. Our next guest is a friend of the show. Sam Lessin is a general partner at Slow Ventures. The company counts Robinhood, Airtable, Solana, and Postmates among its investments. He is also the husband of Jessica Lessin, our founder and editor-in-chief. Sam, welcome back to the show.
Always happy to be back.
So we were texting last night, okay, and one of the things that you seemed a little bit concerned about is this idea that founders aren't dreaming anymore. And I got to ask you what you meant by that.
Well, it's not that they're not dreaming. I think that what's interesting is the appeal of traditional startups where you're kind of sinking 10 years into a journey you're really passionate about. It's getting complicated for a lot of founders. I mean, you saw this with Windsurf, right? Where you saw the kind of founders bail even on something that's kind of working, right? And I think what's happened, there's a bunch of social factors that I think have gone on in the last few years, whether it was COVID or the GME, GameStop, crypto nexus, or whatever you want to call it, that in these times of like massive disruption where things are changing so quickly, people are really nervous to really commit effectively over long periods of time. And so what you're seeing is kind of like the founder dream in a lot of ways. They're really smart people are saying, look, I want to work on things, but I want optionality, right? I want to be able to like pick my right journey, and I don't want to miss the big swerve. And I think that's an interesting shift in kind of patterns, right? You're not seeing people make these like long-term startup commitments in a lot of cases, or when you do, the question is why, right? In a way that I think wasn't the case historically.
So is this good or bad for the startup ecosystem?
It's just different. I mean, I think like the reality is, it's just different. There's an argument that given the level of abstraction and APIs and kind of infrastructure that now exists that didn't exist even 10 years ago, maybe not even 5 years ago, that kind of the most successful things do look like this. Like you have the right idea, you incept something new, and you get a wildfire moment out of it, which then kind of is the value in a lot of ways. I mean, there's a whole other problem about how you compensate early teams, right, in this type of a world where so much of the value gets pulled forward because as soon as something moves, it's worth infinity, right? But it's just different. I think what I think the reality is, the big story is that especially as seed investing, all the patterns that we're all used to are changing very rapidly. And I think you can't just apply old thinking or the old patterns of how you search for companies. Right. You need to be looking for different entrepreneurs and different styles of building.
But, I hear you say this, and it just sounds to me like, patience is something that is running low for founders these days. And it feels like people are,
people are definitely impatient, I think, in general. I think the reality is you have a very liquid labor market. You have a very liquid social experience. I mean, I think Tinder is a great example. Like, who wants to commit to a long-term relationship when you have Tinder on demand, right? It's a little bit simplistic, but you get the point. So, look, I think what does that mean? Will there be opportunities for people who can make long-term commitments that others might miss? Yeah, probably. Right. Will there be a lot of people who kind of not only job hop, but startup hop? It used to be you'd be like the third employee or the fifth employee, you'd expect startup hopping, but the founders, you wouldn't. You're clearly seeing founder hopping in a lot of ways. So is it good or bad? I think it's just different. I think it kind of is meeting the moment and reality of where we are from a development cycle and where the opportunities are. But there is, it's a double-edged sword. I don't think it's all good, for sure.
Has that changed at all? Like the profile of who is starting companies? Are people starting companies later, earlier? Are they taking, more or less
It's too
risk?
early to tell. I think, like, look, the reality is we're in a moment of a lot of disruption. And, what's the little finger quote? Chaos is a ladder, right? And so I think there's a lot of change going on right now, and there's a lot of interesting trends. I think it's too early to tell how all this bakes out. What are we, we're in a bubble. What type of bubble? Where does it pop? What's real? What's not? How are these founder predilections changing in real time? Like, what's permanent versus just a momentary disruption because COVID messed everyone up, right? I think these are kind of like the questions you have to ask right now. I think you have to go back to basics, which is there's no question it's been harder and harder. The legibility of startups to investors has gone way down post-AI. You can't look at an app early and say, oh, this person has judgment or this is good because the app is good because, LLMs make it all too close. Like it's too hard to read signal in it. Your first customer is good for you. You got $1 million. It used to be a big deal. You got your first $1 million in a quote unquote ARR. No one cares anymore, right? It's like too easy with platforms to find the first customers. CAC always goes up. And so that's kind of out the window. And so I think everyone's kind of searching for how to do early investing well in this era where startup founder profiles are changing, where the metrics you can look at and how you can read what's a good and bad startup is changing, et cetera. People will figure it out. The world will move on. Good companies will be started. But it's way too early to say this is how it's going to be, as much as you got to go back to ground zero and think from first principles about where you spend your time and money.
I want to ask you about another tweet that you put out recently. You were talking online about how VCs are subsidizing AI products and services and how this looked very similar to products that we saw, 10 years ago with Uber and stuff like that. Talk about that.
Yeah, I mean, like, look, it's everyone knows this, right? Which is that if you look at kind of the amount that a lot of these kind of, layers on top of, the base models are, the subscription revenue they're charging versus like what they've got to be paying on the back end, the numbers have never made any sense, right? They're subsidizing this stuff. And so people get very excited. And that's happening also at the base layer where, the cost of building these large models and scaling them like way outstrips the revenue. So you have these like very big revenue growth numbers, but everyone knows who's paying attention that you're selling dollars for 50 cents, right? So that's kind of understood. I think the analogy that's interesting is the other place we saw dollars sold for 50 cents was in the consumer internet a decade plus ago, right? Where, there's a joke that, younger millennials, especially urban ones, live this incredible life subsidized by venture capitalists with DoorDash and ClassPass and like all these startups that kind of were, again, effectively selling dollars for 50 cents. Some of them survived, right? Some of them spent, and then basically knocked out all their competitors and then jacked pricing, right? Uber being the best example of that, right? So it's not like an unreasonable spend to oblivion strategy, maybe, but it's a very risky strategy, and it's not necessarily a very healthy strategy. In the response to that in the consumer world is, you had like, for instance, the subscription beauty companies. You had this like big wave of young women obsessed with beauty products because they were basically being paid for by venture capitalists. You then had the response to that, this like clean girl aesthetic, where like effectively the younger kids, when they came up, could no longer afford the products because they got priced properly, and it changed the whole aesthetic, in young culture. And so I think the question of like, how is this all going to play out in AI? Again, we don't know, but it's pretty obvious what's going on.
And I mean, how long do you think it takes then for, this to sort of get under control?
Well, look, I think it all comes down to this question of belief, right? And, a lot of these things are, what we have right now is a hyper cycle of nearly religious belief in AI. And everyone kind of knows, I mean, the information's reported that, for instance, like, we're like, where are the productivity gains from some of this stuff? In some places, they're quite real. In a lot of places, they aren't. They're all on experimental budgets for most companies. There's a huge incentive to play the game no matter what. If you're the CEO of a company and you're profitable, you're like, where am I going to put my profit? And the whole market wants to hear an AI story. And they'll actually even pay you for an AI story because they really want that AI story. Well, guess what? You're going to buy an AI story, right? You're going to tell them an AI story. And so, that game of belief can go on for a long time. If you believe in capitalism, eventually you pay the Pied Piper, right? Eventually this stuff has to rationalize. But the timeline on how that happens, I mean, we don't know. It comes down to these macro factors, around the money. It comes down in the Fed. It comes down to macro factors on a lot of things. But I think at the most fundamental level, there's only two things that stop the bubble, stop the party. One is some sort of major disruption that makes people really go back to ground in terms of what value is and what they want to own, right? a COVID or some sort of displacement that really spooks people. The other is a better narrative, right? And if someone comes up with a better narrative, then like that will become the hot thing, and all of a sudden, AI will be the less good cousin. But that's the kind of the key thing here is like AI setting everything else aside. It's a great narrative, and it's a narrative everyone's willing to pay for, at least until they're not.
I want to ask you about one thing before you go, which is that we've got Circle reporting earnings tomorrow for the first time. You've been involved in crypto. What kind of questions are you sort of focusing on here with respect to stable coins?
Look, I think the use of stablecoins broadly makes all the sense in the world when you think globally. It's one of those things where you can talk about the politics and the history, but in the end of the day, the idea that you have some sort of digital trusted dollar or digital thing that you can move around the world, to pay suppliers and go cross border, it all makes sense. There's nothing that the story makes a ton of sense. And Circle, is one of a few players who's really done the legwork and the hard work after a lot of iterations to make it happen. There are all sorts of downstream questions, like how much do local stable coins matter versus just the US dollar stable, right? Like what does that configuration look like long term? There's lots of people that argue if your contracts are written locally, local stables really matter. There are people that argue that all that matters is the US dollar stable. So these are all kind of subplots is what I would say. The only macro plot that matters is the regulatory side, honestly, because it makes total sense. There have been regimes and certainly the big banks don't necessarily like this because it hurts their margins and their power structure. And so really like when it comes down to what happens to stables, that's the only thing that really matters. But there's a lot of subplots that change the flavor of how this plays out.
But what about questions facing Circle's business specifically?
In the end of the day, I think the thing that I give Circle and Jeremy a lot of credit for is Circle's been around this game a long time, right? And this is not their first rodeo. I mean, they had a big part to play in kind of the pushing stables in a bunch of different directions over time, but that wasn't their first business. It wasn't where they started necessarily. And I think that that's actually the most interesting thing is so many of these things come down to the actual founders and then kind of what they're in it for and what the teams are optimized for. The thing that Circle has proven, and I have a lot of respect for them, is they have a theme, which is around crypto, and they've been unbelievably flexible to meet the moment and continue to do that. So, obviously their earnings matter short term, and like showing that they're having success in stables and where they're going, obviously all makes a lot of sense. But I actually think the real story in a lot of these companies is their durability. And to this point, like, are they in it for a quick hit or are they on the long haul? I think Circle has proven over their long history in many business models and many parts of what they've done that the theme is crypto, the team is Jeremy and co, right? And they're in it for the long haul. And I think that's worth something.
Great. Well, Sam, it's always a pleasure to have you on the show. Thank you so much for being here. That is Sam Lessin from Slow Ventures. Well, that does it for today's show. A reminder that we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I am already excited for our next show tomorrow. And so until then, bye-bye for now.